I'd just like to welcome everyone to the special webinar on the unintended consequences of allocating to ESG managers. My name is Rachel Pether and I'm a senior advisor at the Sovereign Wealth Fund Institute. Now, I know that we have a number of sovereign wealth funds and pension funds on today's call. And as you know, there's been an increased focus on ESG investments. So we've had more sovereign wealth funds joining the One Planet Working Group, which is a consortium of funds that's committed to integrating climate change risks and transitioning to a low emissions economy. And there's also just been an absolute proliferation of ESG-focused investment products and solutions. Now, as always, and Duncan will go into more detail on this a bit later, but whenever there's an exponentially rising interest in something, it heightens the risk that managers and allocators make poor investment decisions. So today we'll be hearing from Duncan Burden, who's the head of research at Stamford Associates, where he leads the efforts in identifying high-performing portfolio managers. For those of you unfamiliar with Stamford, it's a London-based investment advisory firm with over £70 billion of assets under advice. And The Telegraph in the UK noted that they were perhaps the world's most thorough system of fund research for the way that they incorporate behavioural psychology into the investment discipline. So if you have any questions for Duncan during today's talk, just enter them in the Q&A section of your screen, and I'll be back at the end to facilitate the questions from the audience. But with that, I will hand over to you, Duncan.
Thank you very much, Rachel, and hello and welcome to everyone who has joined us today. Very much appreciate your time. Hopefully everyone can see the presentation on the screen. Rachel, does it look like it's showing up okay?
Looks great on my side.
Excellent. Okay, in which case we can kick off. Maybe just to give you a little bit of a background on myself. So I'm head of research at Stamford Associates. As Rachel's alluded to, we're an investment consultancy based out of London with around 70 billion under advice. Myself, I specialize in equity managers, I would say. My background is that I spent about 8 years as a direct equity analyst. So I've been on both sides of the fence. I've been a stock selector and an allocator to an extent. In terms of Stamford and the way that we think about investing, we focus heavily on understanding the people that drive investment decisions. So as a result of that, what you'll see throughout this presentation is that behavioural finance considerations play a big role. And to that end, we have 3 behavioural psychologists embedded in our investment process at every stage. So hopefully that's engaging for you. The premise of the talk is that there's a lot changing in this space. I think lots of investors and fund selectors are scrambling to get up to speed on ESG. So normally that's a good time to just take a step back and think about what's really happening and whether we're all approaching things correctly from a behavioural perspective. So just to give you a brief overview of what we're going to cover. So it's going to be the ESG backdrop as we see it, some of the hazards we increasingly face, the novel behavioural biases associated with ESG, and how our integrated approach hopefully adjusts for some of these biases and hazards. So kicking off with the backdrop to the market as we see it. So what do we mean by ESG and why is it important? So at its simplest, it's around the mitigation of risks related to environment, social and governance considerations. So it's climate, carbon, employees, stakeholders, management and oversight. Why, I suppose in terms of objectives, it's about mitigating, at its heart, it's about mitigating risks related to some of these broad topic areas. But it's also about, for some investment strategies, about identifying thematic opportunities. It's also about reputation management and I suppose ethics to an extent for some different types of strategies. But it's more broadly a recognition that capital markets en masse have profound power to affect change, and we're already seeing some of that happening. In terms of why you should care, broad momentum suggests that all of your peers are really gathering interest in the space. Going forwards, I think there will be greater demands in terms of transparency on ESG related issues, and increasingly, I think the path of least resistance is towards ESG being more of an extension of fiduciary duty in the future. So I don't think it's an issue that's going away, and let's discuss some of the issues around that today. So Perhaps if we just take a step back and think about what the responsible investing landscape looks like in practice. So here I'm introducing a concept which is the balance between, I suppose, expected social or environmental impact on the x-axis with a theoretical expected return on the y-axis. So if we consider the equity market having, I suppose, what you could call a neutral expected return, so a passive market return, implicitly there is a passive societal or environmental impact that occurs around a passive investment. So with that as a backdrop, further along on this continuum to the right, you see ESG integrated strategies. So it's strategies that are fundamentally trying to outperform the equity market, but implicitly producing a better societal or environmental impact. Perhaps slightly further along on that continuum, you have SRI or ethical type strategies, again, trying to outperform the equity market. And let's term those the financial first areas of the market. And that's really what we're interested in today. It's some of the dynamics, the behavioral dynamics around financial first strategies. Just to whiz through some of the other areas on this continuum, so you have social impact strategies, perhaps social enterprise and philanthropy, where you're making more concessionary returns, or I suppose a guaranteed return of minus 100% in the case of donating money to charity. And we can call that the values first sector of the market. So I think it's worth just considering what some of the implications of this. And just to introduce another concept, there must be this part of the chart, which is the, I suppose, investments that make a negative expected social or environmental impact. Let's call that vice investing for the sake of ease. So we might call that oil and gas, tobacco. So I suppose industries that are fundamentally perceived to be not future-proof and bad. I suppose there's a growing perception that these companies will produce lower theoretical expected returns, so underperform the equity market. So I suppose that's observation one. The equity market generally is moving further towards the right, so more people are integrating ESG. And I think implicitly, if these vice companies are underperforming, there must be, on the other side of the equation, this trend of ESG integrated strategies outperforming. That's just the mathematics of how these things work. Now, it's not necessarily me saying I'm not underwriting that I think that vice companies are going to underperform, but I think it's just important. This is kind of a backdrop that we're operating against, and I suppose broad opinion is moving in this direction. So, in terms of still on the backdrop here, what have we seen in terms of the momentum that ESG is gathering? So profound network effects are in place. So what you're seeing here on this chart is the trailing 12 months signatories to the UN PRI. And I mean, it goes without saying that this is an exponential chart. So over the last 3 years, massive increase in interest. Capital is flowing into the ESG space at a rate of knots, and that is expected to continue over the next few years, undoubtedly. And I think there's a consumer preference tailwind as well. So what you're seeing here is Google search volumes of ESG related search terms. And again, you can see that exponential explosion in interest. So that is the backdrop, lots of exponential charts. And I think we've seen a lot of those throughout 2020. But I think, to my mind, complexity, and these are complex issues we're dealing with. So complexity combined with exponentially rising interest heightens risks when it comes to allocating or making investment decisions. The first one that I'd like to touch on is that of valuation risk, where you have capital, profound capital flowing into a space. There's always the risk that assets get bid up. Consequently, there's always the risk that those assets derate eventually when sentiment changes or when flows reverse, so reversal risk. There's the risk that we as allocators misattribute historical strong performance to skill when in fact it's more related to some of these capital flow dynamics. There's the risk of greenwashing and allocating to a manager that is good at creating the optics of a properly ESG integrated strategy, perhaps without substance. There's the risk that you allocate to a manager who is basically in the SRI or ESG space to capitalize on inflows and has no real provenance in the space and has no skill, frankly. And then there's the risk of generalizations. And I appreciate the irony that I'm generalizing slightly on this slide, but I think core to all investments is that every investment needs to be considered on its individual basis, case by case basis. And we see a bit of generalization in the ESG space. So to my mind, there's a cautionary tale here. So understanding ESG across different managers is certainly a complex and an abstract issue. We think full transparency is required, and it's important to think about how ESG integration impacts behavioral biases and the decision-making frameworks. So I touched on this issue on the last slide, and that's the issue of greenwashing. So what do we mean by greenwashing? It's the process of creating the illusion of ESG integration for marketing purposes, but without substance. And I think that is an issue, but perhaps what we're more concerned about is the concept of fundamental washing. So this is a term that we're coining. Effectively, what that is managers who create the illusion of a genuine research-led investment process without proper investment substance, and I think that's where the real selection errors are taking place, perhaps to a lesser extent than in the greenwashing area. So it's probably a good time to think about how to think about ESG considerations as they relate to fundamental analysis. So I think the path of least resistance is towards greater integration of ESG considerations in broader fundamental analysis. And as we know, it's a growing space and it's becoming more important. So integrating ESG considerations at analyst level is extremely important. We think it's an enhancement to fundamental analysis. It shouldn't necessarily be considered a separate function. It's all part and parcel of the decision-making framework. The risk of permanent loss of capital remains the core consideration, and indeed ESG can help in that endeavour. It's all about the quality of decision-making, so it's important to understand how it impacts decision-making. Focus on the evidence, so look for evidence that things are happening in a way as espoused by the manager. And as I say, ESG considerations create these new behavioural challenges, which we can touch on in a little bit more detail. So as I mentioned before, integration of behavioural considerations is quite important, we feel. But I think why is it the case that ESG ought to be integrated at analyst level? Fundamentally, it's because we think that ESG analysis and investment analysis, they're fundamentally the same skill sets and disciplines. So we're looking for individuals that value highly proprietary, forward-looking insight. So it's identical to fundamental analysis. We don't think that people that just blindly use third-party data providers have any edge in understanding the ESG risks associated with a given investment. We think managers need to value granularity. They need to go into the correct level of depth to understand some of these complex issues. We need to see sufficient resource. We need to see independence of thought. ESG credentials are inherently, they're quite subjective, but we see quite a lot of conformity in the way that people think. So when we hear a manager talking with an independent line of thinking, that gets us sitting up and thinking, which is a good thing. So we're looking for behavioral calibration and resilience. So people that are calibrated to the biases that are inherent within their investment processes, and those that are resilient to controversies as they arise. And I think that's an interesting debate that we can have a little bit later on. And ultimately, we're looking for people that can allocate their time correctly to the right types of information. So, as I've said, these are fundamentally the same skill sets. So it almost demands analyst level integration. So perhaps a good time to move on to these novel behavioral pitfalls, as we're calling them. And I think, the behavioral finance in normal investment decision making is a well-established and highly credible way of thinking. So hopefully this will introduce a new angle on that topic. And there are two categories that I wanted to talk about, and within that, three biases. So for portfolio managers, so think of these as biases associated with equity portfolio management. And I'll come onto these in more detail in a minute. And then for allocators and manager selectors. So this is for us as the selectors, the appointers of managers to consider. So thinking initially about an equity portfolio manager, and this is the concept of attentional biases. So this is how to prioritize the right information to make the right decision. So I think, traditionally in a normal investment process before ESG integration, the realm of a stock selector was effectively anything that was material to the long-term company prospects of a business. So that's the right area to focus your time. Anything that is immaterial to company prospects is where you have the potential to waste your time effectively. Now, clearly, there's another axis here, which is whether things are material to share prices in the short term, and that relates more to noise. But ultimately, if you are focusing all of your time here, that was a good thing. So what does that look like in practice? Before ESG integration, new information arises on an incumbent investment, for example. Is this information financially important? If yes, then the debate moves to, is this information priced in, yes or no? Now, if the answer to that initial question is no, historically, that information could be ignored and the manager could move on to the next piece of information or the next research project. So I suppose for a historically traditional investment process that is now integrating ESG considerations, new information as it arises, the same initial question has to be asked, which is this financially important? Is it worth my time to think about this? Now, if the answer is no, that's not necessarily where the story ends now. Is this important to my ESG framework? Is there some implicit moralistic view that I'm expressing, yes or no? And I think, the key point here is that any point where you're introducing new decisions to a framework, it's a new opportunity to make mistakes and a new opportunity to frankly waste your time. And you've got this conflict here between information that may not be materially financially important, but it requires careful consideration because it's important to the way you're integrating ESG into your process. So it's something which we think about carefully. So this is the second bias for portfolio managers. This is around confirmation biases. So this is when to consider information that may be appropriate. So you may be, hopefully you'll be familiar with the concept of the 80-20 rule, which is this concept whereby I suppose a decision maker can in 20% of their time gather enough, 80% of their information. They can gather 80% of their conviction in a relatively short period of time, after which there is a diminishing marginal return to incremental time allocated to a particular research topic or project. So consider this, if you're a portfolio manager and you're considering ESG considerations after that decision has been substantially made, so if it's, I suppose, an afterthought to your process, to what extent can that genuinely impact a decision? As a manager, you've already allocated and invested a huge amount of intellectual capital into researching an individual idea. To then consider something that is subordinate to your normal investment process implicitly because of the way that it's ordered must be difficult. So that's something that we need to consider. So understand when your manager is considering ESG and to what extent does that affect the propensity to act. The third bias for portfolio managers I wanted to discuss today was this concept of contrarianism, and this is an interesting one, I think. So it's a concept that is clearly quite important for an equity value manager. So consider a typical value manager purchase decision. So scenario one, share price drifts downwards as a result of not much, perhaps just a little bit of sentiment, a sector rotation, and an opportunity arises where the shares are trading significantly enough below intrinsic value to warrant a purchase. Consider scenario two, where exactly the same thing happens in terms of the level of share price correction, but it's a social controversy. It happens on a single day and the shares effectively rebase. You've got a spread to intrinsic value, which is almost identical. To what extent is that manager, the same manager, motivated to act with a contrarian moral stance in scenario two? I suppose you're publicizing a moral stance that is against popular opinion. And again, this goes to this concept of growing conformity in the space of ESG. So there's a certain irony that is introduced by this dynamic. If all managers who are ESG integrated are less likely to purchase this company or more likely to sell it on the other end of the equation, I suppose by extension, this spread to intrinsic value will likely widen and it will become more attractive to value investors, theoretically. So the question is, what is the second derivative impact of ESG integration on, I suppose, the doctrine of value investing? Does it impact it over the long run? Okay, so we've dealt with a few biases for equity portfolio managers, perhaps now we can have I suppose a little bit of self-scrutiny and think about the way that we're interacting with the concepts of ESG. So this first one is around misattribution biases. And I've already touched on the concept of misattributing historical outperformance to manager skill, when perhaps it's more related to, I suppose, the dynamics of capital flows. But there's another one that I just want to discuss today, which is the concept of I'm happy to pay a premium for an ESG proposition because it's ESG integrated. But I think what needs to be considered carefully is what is the economic driver? What is the reality of what is driving an investment proposition economically? I think that's the most important thing. So what we're showing here is the correlation of position sizes of a popular MSCI USA ESG ETF versus a popular S&P 500 ETF. So an ESG integrated passive solution versus a non-ESG integrated passive solution. And as you can see, a spookily high correlation between the position sizes, with only one real delta, and that's I think that's Tesla, which probably has to move up there anyway now that it's been admitted to the S&P. So the question is, why are you paying 5 times more for this ESG ETF when economically you're getting substantially very similar investment content? So the overlap between these two ETFs, I think, was around 80 to 85%. The question is, for that 20% that doesn't overlap, how are you justifying that incremental 5x on the fee that you're paying for your clients? So the advice is, be discerning. Don't necessarily accept that ESG is more expensive or should be more expensive just because it's a novel space and people are increasingly allocating towards it. I think it's important to just map back to what is the materiality of what I'm investing in. So this second bias for PM selectors is the concept of representativeness biases, and this is really around weighting mistakes properly as they arise. So it's about let's consider a mistake as it relates to ESG as a controversy, just for ease's sake. So I think everywhere in any kind of decision making, mistakes are to be expected. So in traditional investment, there is an accepted orthodoxy that everybody makes mistakes. And I suppose to an extent where we're guided by outcomes. So, I've outperformed the index, that is my outcome. So the mathematics are very clear as to whether you're breaking even effectively on your investment decisions. But there's many different ways that you can achieve that same outcome. So what I'm showing on this chart here is a break-even batting average versus win-loss. So there's lots of different ways you can achieve a market return. So you can either get half of your investments right and have your winners be approximately the same size as your losers. You can have a few very large winners offsetting relatively inaccurate stock selection, or you can have highly accurate selection offsetting a few large mistakes. And all of those achieve the same end, but in a very, very different way. So the question is, how does this map onto ESG? So we have a natural tendency and bias as humans, frankly, to look at the biggest and most pressing and most obvious errors that are sitting in front of us. So the large ESG related flare-ups draw the attention. But what about those small, under-publicized oversights that are flying under the radar? What is an acceptable error rate? Is it acceptable that one ESG controversy per year is fine? These are questions that I don't necessarily have the answer to, but it's worth a bit of self-reflection and thinking about these things. Does there exist a moral break-even in the same way that there exists a moral, I suppose, an investment break-even, i.e. a market return? And I think, related to that is how are we weighting controversies and ESG issues with the positive impacts and outcomes? And as we know, positive impact is quite a difficult and abstract thing to quantify. But I think logically there needs to be some kind of offsetting factor of the positives with the negatives. And this final one is really this is a question. It's what I'm calling authority bias, and this is questioning how we as allocators, how we as interviewers of fund managers are engaging with portfolio managers, and how we are perhaps inadvertently influencing the way they think about things and their behaviors. So let's take a given controversial company. Highly visible issue. It's on the front page of the Financial Times, even The Economist. that piece of information logically would have a high probability of being priced in by virtue of its publicity. So naturally, as allocators, as I suppose stewards of capital, we need to be on top of that. So those pressing issues demand attention. We'll be on the phone to a manager, perhaps asking them about them, or during our quarterly reviews. Clients en masse, because of the publicity, will be pressing the portfolio managers in I suppose a coordinated fashion, which in turn demands more of the portfolio manager's time. The less latent, the more latent issues in the portfolio are afforded less of the portfolio manager's time as a result. And ultimately, at some stage, those latent issues may well become pressing, and at which point this sort of vicious cycle comes into play, which is not ideal. So I think it's more just about thinking about what topics you're engaging on with the manager. It's about understanding how controversies fit into their process and whether they're acceptable given what they're trying to achieve. And maybe just taking the time to engage with the portfolio manager on some of the issues that they perceive to be latent within the portfolio that are not being debated in the press and in the public. I think the more time that portfolio managers spend on issues that are already priced in, the more they're wasting their time. And if we can play a role in averting that, then that's a good thing. So I think, it's certainly a cautionary tale to date, but I think it goes without saying that ESG integration can help you achieve good outcomes for your clients. So anything that improves the chances of compounding capital over the long run is a worthwhile endeavor. And I think the way that ESG focuses the mind is it ought to be, when done properly, it ought to be about forward-looking, long-term appreciation, holistic appreciation of the fundamental investment case risks associated with a given company. So I think it's important for us to go beyond the marketing. It's marketing hides a multitude of sins as it relates to ESG integration and investment processes, frankly, as well. As I say, better sight of long-term fundamental risks, ultimately culminating in theoretically fewer permanent capital losses. So I think this is how it ought to be thought about. So I'm just going to touch briefly on how we attempt to adjust for some of these biases and hazards that we've seen. So it's a 6-step approach. It may seem simple, but it really is incredibly detailed at this stage. I suppose below the iceberg, below the output. In the first instance, it really is about understanding the manager's approach. So what does it mean to the manager? It's undoubtedly the most important step. There is no such thing as a one-size-fits-all approach. So it's about understanding what the manager should know, what they shouldn't know, what they are trying to do, and what they aren't trying to do. And then for us, it's about interrogating the materiality and quality of that ESG framework. We need to vouch it as well. So it will take a great deal of time carefully trying to evidence claims made by the manager. And this is the easiest way to adjust for that greenwashing bias. Again, integrate behavioral psychologists into the process to help understand some of those dynamics a bit better. And then it's about trying to map, I suppose, the outputs of this work onto the outcomes as we see them in portfolio footprints. So in trading decisions, in performance, how these decisions have impacted outcomes. And then in terms of the output, as I say, a lot of work goes into this, but it's about simple appraisal of a decision-making framework. And I'm not going to dwell on this in too much detail, but the reports and the output that we produce is all very bespoke. It's all very bottom up, and it's tailored to a specific client's requirement and obviously a specific manager's process, culminating in I suppose, an easily intelligible appraisal of whether something is a best-in-class or a worst-in-class approach to ESG. So at this stage, we come to broadly towards the end of the main body of the presentation. What I'd plan to do now is just for a little bit of hopefully something a bit fun, is just to introduce the concept of some ESG paradoxes. And I've got a poll that I want to launch alongside this, so hopefully that'll work. Wish me luck. So the first one I wanted to launch or to introduce was this concept of the ENS seesaw, as I'm calling it. I'm going to launch the poll now, so hopefully you should see that popping up on your screen, and I'd be very grateful if you could lend your opinions. So it's a difficult debate with no single answer, but the question is fundamentally, does the shift to new technology-driven, environmentally friendly industries justify job destruction in legacy industries? So let's say hypothetically you see huge job destruction in oil and gas, but environmental gains in wind energy, for example, but with a net destruction of jobs. How does that balance? What are your views on whether that is morally acceptable? Perhaps moving on to the next slide. So this thing that I'm calling the profiteering paradox. So that is the concept of to what extent is it okay to make money out of ESG investing? So perhaps with reference to short selling in particular. So if you have a short seller in a hedge fund, effectively making a profit from short selling bad companies, is that a bad thing? What about, by extension, what about if a short seller is engaging in a short and shout strategy, i.e. it's a hedge fund analyst constructing a convincing bear thesis, publicizing it, accelerating the demise of that company, perhaps leading to job destruction? Is that acceptable? This is a paradox I'm calling the taxation paradox. This is an issue that's been, I suppose, quite a sensitive political issue around corporates for a long while. And it's around the level of corporation tax that companies pay. So is any form of corporate tax mitigation acceptable under ESG integration? I suppose what we have is this tension between the interests of shareholders and society. So under the Friedman doctrines, mitigating tax, i.e. reducing your cash tax bill and implicitly boosting your free cash flow, is surely best for shareholders over the long term. But as I say, there is that social tension. So what level of tax mitigation is acceptable? And perhaps developing that concept a bit further. What if you have a company that is particularly efficient at reinvesting its free cash flow, excess free cash flow, in terms of the impact it makes on society? So if you have a company that is a retail company, let's say, embarking on a store rollout program, paying no tax, but reinvesting their free cash flow in a store rollout, which creates thousands of jobs, is it acceptable that they pay no tax? Is it preferable, in fact, that they pay no tax? Difficult questions to answer. This is a paradox I'm calling the causality paradox. So this is the concept of whether good companies perform better and become big, or whether it's big companies that have the budget to have large CSR budgets and appear good. Does that sort of does the authenticity of whether a company is genuinely good or has the budget to make itself good, does that matter? And what impact does that have on investment returns going forward? And this final one it alludes to that initial slide where we were talking about vice investing and the trade-off between good companies and bad companies. So this is, I suppose, the theory of ESG is that better returns accrue to investors in good companies, as they'll be rewarded with a lower cost of financing. And it might be the case that good companies are the recipients of more market share because they are with popular opinion. I suppose the catch to that is the extent to which goodness has been priced into securities already and what that means for future returns. So, if we consider two companies, Caring Company and Evil Enterprises PLC, so it's quite obvious which one's the good and the bad company, but this is dealing with the concept of perception and commensurate valuations. So Caring Company is a great company and priced accordingly. If the perception remains the same and the valuation remains the same, still expensive, you might accrue an okay return, maybe a return that's in line with the cost of capital. For an evil enterprise, it's a bad company and priced accordingly. Let's say it remains a bad company, still cheap. Does that mean you accrue a poor return, maybe a market return if you're lucky? I think where this gets interesting is the concept of if this company is now considered great, if there's some form of self-help that the company can enact and it becomes a great company, the shares re-rate, surely that's the best return to a shareholder. That's the best way to accrue a return. And I think this goes to the point I was making earlier on about perhaps the emergent lack of contrarianism in the ESG integration space, moral momentum. So another concept just to introduce here is what happens to Caring Company PLC if it is now considered an average company. We're not even going to the depths of you know, this falling from grace to becoming evil enterprises, but just an average company. What impact does that have on your future returns? So these are some important considerations, and I think, you know, in some ways the bias towards looking at historical ESG data feeds into some of these biases, which is why we think it's important to look to the future and think carefully about your behavioural biases. So that brings us to the end of the presentation. So I'm sorry that we weren't able to share the results of the poll. Let me see if I can, here we go. No, I tell a lie, I've found them now. So I can tell you that, let me just share the results of question 1. Does the shift to new technology-driven, environmentally friendly industries justify job destruction in legacy industries? So a bit of a spread of opinion, and there's only one proponent of protecting legacy industries. This is all anonymized, so don't worry, you haven't been exposed. But I think it shows that there's a bit of diversity of opinion, and I'm glad to see that people understand that these are complex issues, and the answer isn't necessarily clear. So I'm just going to quickly, I'm going to attempt to launch the second poll now, which is that final one, which is around, I suppose, your opinion on the extent to which goodness is priced into investments within the ESG space. So if you have a moment, it would be great if you wouldn't mind showing your views. The results are now coming in. Now, this is very interesting. This is very interesting. There's a lot of conformism I'm seeing here. So there seems to be a dominant view that the bad companies with the potential to improve will earn the highest returns going forward. Interesting. Okay, great. Just a few more votes to come in, but let's stop the polling there and I'll share those results. But I think, you know, ultimately, hopefully you can see those coming up on your screens. Hopefully these polls just highlight that you're dealing with very complex topics. There's a range of opinions, and sometimes it's difficult to understand which view and which moral stance you need to express in your investment program. So I think that's why it's important to listen to your client and not try and impress things upon them necessarily. So, as I say, that brings us to the end of the presentation. So I'd be delighted to open up to a bit of Q&A if any questions have come in.
Thanks so much, Duncan. And I'm also very impressed that we made it to, like, I think it was 33 minutes before we had any technical difficulties, which I think actually wins the prize in terms of webinars I've attended. I also actually don't have the option to turn my video on. If you could turn it on for me. We have had a number of audience questions coming in, so I would like to make sure we address those.
I don't know how to turn on your video, Rachel. Maybe we can.
That's fine. I will just lurk in the background then. But we've had a number of questions coming in, Duncan. We have a broad one and some specific ones. So I'm actually going to start with the specific ones. Someone has asked, you mentioned about that managers may indeed be greenwashing. What sort of questions would you ask managers from a behavioural finance perspective to see if they are greenwashing? What are some triggers that you look for?
Yeah, so I think the easiest way to spot a greenwasher is to understand, I think, the point at which ESG is considered in their process. Now, as I say, I'm contradicting myself because earlier on I said that there is no one-size-fits-all approach. But to my mind, if you're seeing a manager who's just integrating ESG considerations at the end of an investment process, perhaps looking at backward-looking data at the end, perhaps as some form of confirmation bias, that's a pretty good sign. the easiest way, and this doesn't necessarily relate directly to behavioral type questions, but the easiest way to isolate greenwashing is to discuss individual companies. So that ought to be any part of appraising a manager's process, but understanding how ESG has fed into an individual decision is very important, and looking for evidence that ESG considerations have impacted outcomes at some point in time. I think one of the most powerful tools is asking about mistakes as well. Asking managers to volunteer where they've got things wrong as it relates to ESG in the past, and understanding what they've learned about them and how they tweaked their investment processes to try and adjust for those mistakes in the future. So I think there's a few ideas there, if that makes sense.
Yeah, that's great. And that was actually, incidentally, a beautiful segue to another audience question that's come in, which is, what are the biggest mistakes you see managers making on ESG at the moment? And I guess you can take that from a sort of maybe a higher level approach, but also more of a micro view.
Yeah, okay. So I think the biggest behavioral mistakes. So my view is that ESG and investment should be considered as entwined. So I think the biggest mistake managers can make is crystallizing losses in controversial companies without reference to the long-term attractiveness of that individual investment. So that happens in general investment, forget about ESG. But I think where managers are attributing historical crystallizations of loss to controversies, I think that's almost an outsourcing of responsibility. I think it shows that they're not owning that investment decision, and they're misattributing it to perhaps some form of moralistic view which needs to be expressed in a portfolio. So I think that's a behavioral mistake, but it's about reacting badly to new information and not taking the time to weight it and act on it appropriately. That's the biggest one that I've seen.
And we've also had a question coming in on, are asset managers too reliant on third-party providers?
So it's difficult. I don't want to get into the accidentally slandering the ESG data providers. I think because it's an emergent space, I think everyone is trying to improve and improve the outputs. And I think actually that there's a lot of value that can be added by looking at third-party data providers. They can steer people in the right direction, and I think anything which highlights relevant investment case risks to a portfolio manager so that they can appraise them under their own framework, I think that is a worthy activity. So I think if people are using them correctly, that's absolutely fine. I think where it breaks down is where managers are solely just basically running their portfolio through a Sustainalytics screen, for example, not to pick on Sustainalytics, and saying my ESG score is good, therefore I am ESG integrated. That to me is not what this is about. It's about understanding the bottom-up fundamental investment case risks. So it's difficult to say whether they're using it too much. I'd probably the question maybe is, is the asset management industry using them in the wrong way? But I think it's fair to say that the conversations we have with managers suggest that they don't en masse naively use data outputs from third-party data providers. I think there's a genuine intention and a will to get better and to do more things in-house, I would say.
Mm. And I don't think we have anyone from Sustainalytics on the call, so you're okay with just calling them out. And we also had a broader question coming in, and you mentioned, Duncan, that looking at ESG, it can also be possibly a new opportunity to make mistakes and waste your time. So what would be your advice for a sovereign wealth fund that's looking to implement an ESG policy for the first time across its portfolio? So including all these different types of asset classes like private equity, equities, fixed income, appreciating that you're mainly focused on the equity piece of that.
Wow, what a great question. Tough one. I would say I think my view is that to apply the same framework across different asset classes is even more difficult than applying exactly the same framework across different managers. And from what I've seen, individual investment strategies are, their approach to ESG integration is often very, very different between managers. And the framework that we've designed is not prescriptive. It doesn't require that we go through exactly the same rote process per manager. So every ESG appraisal looks very different from our perspective within managers. For us to then port that to a different asset class is an even bigger leap. So I think the message I would say is just have a disciplined approach. Have, I suppose, an overarching set of principles that governs how you think about ESG, but everything needs to be considered on its individual merits. Don't fall foul of that generalization hazard that I alluded to earlier on. Yeah, that would be my advice.
No, that's great advice. Thanks so much, Duncan. And we have actually run slightly over time. I know we said this would be around 30 to 40 minutes, and we're almost 50 minutes in, but I did want to make sure that I got to all the audience questions. So if there's anyone on the call that would like to follow up, how should they reach out to you in Stamford to learn more about ESG and your approach?
Yeah, I feel free to get in touch. These are topics that I find fascinating, and the 6 biases that we discussed today are 6 of many. So if anyone's interested in learning more, then please feel free to reach out.
Excellent. Thanks everyone so much for joining the call. Kate, who I'm sure most of you have been speaking to, will be sending out a replay after this as well. But from my side, thanks so much for joining us today. And Duncan, thanks as well. That was a really interesting presentation and discussion.
Thank you. Thank you all.